What will your repayments be when you look for a refinance, refixing, and some of the implications, some of the costs, right there? That's what we're going to get into right now.
Yeah, just to consider some options before you even consider refinancing or choosing a different rate.
And some of these rates are looking great right now. I've got to say, it's nice having these conversations where we're not like breaking people's hearts.
Only six months and 1 year is over 6%. Everything else is, except also floating, obviously.
Yeah, and I guess the question you get a lot is, should I fix for 6 months or 1 year?
Or maybe 18.
Yeah. How do you approach that?
I think they just need to understand how soon the 6 months will even be balancing with 1 year or 18 months. So let's say it's $500,000 mortgage. You fix on 6 months, maybe 6.69, for example, and versus client B scenario, $500,000, 18 months is already 5.99. Mm-hmm. So in order for a rate to break even, you have to have a significant drop in 6 months. So let's take an example. Next 6 months is maybe 6.45 or 6.39. So you're already committing for 1 year so far.
Yeah, I know what you mean. And the thing is, I had someone make a decision exactly on your point the other day, but I always just say, if you can't make up your mind, just split it into two. Fix some for 6 months and some for 18 months. But yeah, that 1 year rate is looking pretty attractive. Some of the other costs involved, though, if you're refinancing, Dev?
Mainly, I think the cost. We have some cost comparison sheet that will.
Well, yes, we have this thing here, and look, we can actually do estimations of a benefit. But here at the moment, what's happening is some banks. So you might have a break fee because you might be looking at these things early. Now, if you've been with your current bank for more than 3 years and they don't want any of the cash incentives back that they ever paid you, or if you've never had any cash incentives, great. Like you've been there for a long time, then what you might find is that your estimated break fees get covered by what's called a cash incentives that the banks are paying, which are roughly running at around 0.9% of the loan amount. So sometimes we can do this cost comparison sheet. It doesn't cost you anything. We can actually do this calculation for you in-house where we can go, right, the difference in rates, let's say in this example, there's a profit there of about $3,900, but you're paying a break fee there, there's lawyers' fees involved, but the new bank is paying you something. So in this example here, this person would be ahead by $5,000. And of course, it would feel nicer as well, being on a lower rate.
Yeah, obviously. And then technically, if you compare 0.9% cashback, it's nearly 1% off your interest rate.
In some ways, you could look at it like that,
Yeah, so 6% is technically become 5%.
Yeah, and some of the other things I also think about is, this is a 25-year term. So when you look at some of the repayments here, actually, let me just do this for 1 million. Just make it a bit nicer in 30 years. Okay, so this is kind of comparing side by side. So the repayment difference here, you'll find, is not a lot. So sometimes when you're switching banks, and if you're not good with revolving credits and offsets, what should you do?
I would personally stick to the lower term because I don't want to extend it back to 30 years and just do peace of mind. But it keeps me motivated to be a mortgage free.
And psychologically, it feels a bit nicer. So, any other tips, pro tips for refinancing? I mean, come to us.
Yeah, and we can do this cost comparison upfront before you say, okay, let's do some numbers, anything, but we will just do some random calculations to see, okay, is it worth it?
If you have multiple properties, there could be other desserts, fruits, or what would you call it, treats that we might have for you, such as freeholding property, right? If you have too much equity with the bank, which is really, really important, especially if you set up for later years like retirement and things like that.
Or when the property market goes up, you don't have to be told off by a bank that we need all of your money from that house.
When you sell, you might want to buy 2 smaller ones instead of one big one, for example, and you can kind of do that independently. The other thing that we also look at sometimes is in terms of whether your accountant needs to have a chat to you about tax structures and things like that. Family trusts, sometimes those things become important.
Discussions.
Yeah, as well. Anyway, thanks for watching. It's getting
Thank
Yeah.
you.